Okay, story time. The Fed just nudged rates down, mortgage yields dipped into the mid-sixes, and the headlines went bonkers. Housing rebound, refi stampede, cue the confetti and the bandwagon. But if you've watched markets for more than a headline or two, you already smell the reheated take. The real picture, messier, uglier, and for the savvy, much more interesting. And if you want the deep zip code stuff, I summarize that every week in the Deal Watch. Link is in the description. Free newsletter. Go ahead. Here we go. All right, stick around. I'll remind you at the end. And quick heads up, this is me being opinionated and speculative. It's not financial or real estate advice. I'm not a licensed real estate person, an attorney, or a financial advisor. I'm just a guy who's doing research, looking at stuff, and watching a whole bunch of videos. Do your homework, talk to a pro before making any big moves, all right? Let's go. Here's my hot take in one sentence. A tiny Fed cut plus a temporary mortgage dip does not fix a broken affordability equation. You can hype interest rate minutia like it's a miracle cure, but buying power is math, and math says buyers are still priced out. Average monthly mortgage payments are still roughly double pre-pandemic norms. Sure, a quarter point helps, but it doesn't erase decades of price appreciation, higher taxes, insurance spikes, and wages that didn't quite get the memo. Now for the spicy part. Why this feels different from past slowdowns. We're not just watching tired sellers take losses. Two big forces are converging. Speculative inventory, hello, Airbnbs, and build for flip neighborhoods, hello, and builders who are suddenly staging a discount war. That's a brutal combo. Short-term rental zones that ballooned during the pandemic are now getting flooded with properties that don't cash flow anymore. Investors who are banking on 2021 summer rates and endless tourists are waking up to vacancy, higher operating costs, and financing that won't forgive cash flow shortfalls. Translation: these investment homes are becoming motivated sellers overnight. Meanwhile, builders, for who years got drunk on demand, are in full-on incentive mode. Price cuts, mortgage rate buydowns, and flashy giveaways are trying to pull buyers into cookie-cutter suburbs. It works a little, but not nearly enough to absorb all the supply. So what happens? Existing homes, which used to trade on scarcity, are getting hollowed out by overflow new construction and bargain incentives. In plain English, like a pillow, the market stuffing is being pulled out from under it. And let's not ignore geography, guys. The housing market isn't a single beast, it's a patchwork. The Sunbelt boom that people bragged about, that's where a lot of the speculation in new builds clustered. So those markets are the ones wobbling first. Florida, parts of Texas, Arizona, those places took the big swings up, and now they're seeing the big swings down. The Northeast and some Midwest pockets, they're stubbornly holding, often because the narrative, quote, this place is forever valuable, still props prices, but narratives change, people move, demographics matter more than hashtags. Okay, roast time, light and with love. California, you built a paradise for rents and a maze for first-time buyers. You can keep your coastal tacos and overpriced integrity, but the math isn't immune. Same for parts of the PN dubs, Pacific Northwest. In their we're too cool for moderation neighborhoods in Oregon and Washington, trendy doesn't pay the electric bill. When tourism wobbles and tech layoffs hit, the glamour evaporates fast. So, what would actually get buyers back in a sustainable way? Two things: lower payments and realistic prices. My rule of thumb, to nudge mainstream affordability back toward the normal, we need something like a 15% drop in prices, I said this the other day, and mortgage rates closer to the low 4%. Either one alone is messy, but together, that would restore the math that makes a middle-class buyer confident to transact. Now, will that happen soon? I'm skeptical. A sharp fall in rates without a recession seems unlikely. A 15% price reset in lots of metros is totally plausible and happening already in slices of the Sunbelt. Here's the practical investor/buyer playbook from my cynical corner of the internet. Stop listening to national pundits and start looking at microdata. Inventory, days on markets, percent of listings taking price cuts, and actual sales, not just the Zillow headlines. If your zip code shows exploding inventory and sustained price cuts, that's where bargains form. If your market still has low inventory and high to buy rent yields, cool. Maybe sit tight or don't. Each situation's personal. Two quick warnings for people tempted to sprint into discounts. Number one, watch insurance costs and property tax exposure. They're the silent margin killer. And yes, some insurers are pulling back into risky areas. Number two, don't buy a house you can only afford if rates return to fantasy land. Betting on rates falling a full point or two is a gamble, not a plan. And since you'll ask, yes, there will be opportunity, lots of it. but opportunities are local and often messy. If you want a weekly zip-level email that hunts these micro moves down like Sherlock Holmes, Deal Watch pulls that stuff together and lays out where we see inventory spikes, price cut clusters, and actual motivated sellers. It's not a hard sell, it's a tool. Link in the description below if you want to subscribe. Final snarky wrap. The housing market will never be the same in the sense that the 2021 narrative of buy now, everything always goes up is dead, buried, and it's on its fifth eulogy. If you're a buyer or investor, welcome to the era where discipline, data, and a little cynicism beats hype and FOMO. If you're a seller who still thinks your house is a guaranteed retirement annuity, enjoy the delusion, but don't be surprised when the inbox of lowball offers starts to look like a spam folder. All right, that's my opinion. If you like the brutal honesty, subscribe, turn on notifications. And again, if you want the zip code intel I mentioned, click the Deal Watch link in the description below and get it in your inbox. I'm not your financial advisor. I'm the one who tells you the obvious stuff your realtor won't. See you next week. Later, bye.